Thank you very much, Professor, and for all of you for coming here. It's a real pleasure to interact with such a smart crowd, and I've already been peppered with questions, and the questions that I've got so far sure make this feel like a very interesting evening is what I'm in for here. Um, as the Professor mentioned, that I've been a writer for as long as I've been an investor. I started writing around 20 years ago when I was back in India, and I just finished my high school, and I was very interested in the topic of global economics, and I wanted to do something to be involved in that field. At that age, I couldn't find enough people to relieve me of their wealth, so I could not sort of. I wanted to be a fund manager, but at that age, obviously, there was no way that I'd get that kind of money from people, because they wanted a bit more white hair and other sort of things before they do that. But I found an opening back in India then that I started writing for this newspaper they called the Economic Times. And the interesting thing then was that I was able to get an opportunity because this was 1991. The Indian economy was just about opening up to the world. The largest financial newspaper there, the Economic Times, wanted someone to write on global affairs, but none of the regular people wanted to write about global stuff because it was considered to be so marginal and irrelevant. So I was able to sort of find an opening out there, and I began to write about a weekly column on what's happening in foreign exchange and other sort of things in the global economy. So that I was doing that on the side, but it was of still studying in college. But the interesting thing was how irrelevant at that point in time, in a place like India, the rest of the world seemed, because it was a very closed economy which was just about opening up and following the footsteps of China, which had started to open up 1978 onwards. And as the years went by, the interest obviously picked up a lot in what was happening in the global economy. In 1996, I was all set to come and do my PhD here in the US because I was keen to sort of learn more about what's happening in the economy. And it was back then that one of the Morgan Stanley senior executives visiting India, their attention was drawn to my column that I used to write for the Economic Times, and they were sort of intrigued that who's this young kid writing out here, and then I had a few meetings and conversations with them, and one of them then made me a job offer, and basically, so I told him like I want to really go and study further in the US and come to an institution such as Columbia or something. And his response to me was, do you want to make money or do you want to study? So I said, listen, I want to make money. So with that, I started my investing career back at Morgan Stanley in 1996, and I moved to New York to run the emerging markets group in 2003, and I've been here for the last decade. And as I look back over the last 20 years, I'm just fascinated by the number of cycles that I've already seen, how fads come and go, and how trends are rarely permanent. And to me, that's really the single most important thing which makes this business so interesting and yet also so challenging. Because the biggest mistake that we all tend to make is the mistake of extrapolation, which is that whatever the trend has been there for a while, you tend to draw a straight line and assume that this trend is going to continue ad infinitum. And that to me is the biggest mistake that we all tend to make. And that's what I began to feel about many trends in emerging markets, including on China, in late 2010. And here's what I mean by this, that even that when I first started doing emerging markets, as I said, on a professional basis in the mid 1990s, emerging markets were considered quite hot and exotic because they had just been discovered by Wall Street 6-7 years ago. A lot of money had flown into emerging markets. And then from the mid 1990s right up till the early part of last decade, emerging markets were neglected, and nobody wanted to touch them because there were so many crises in emerging markets. It started in 1994, in December 94 with the Mexican tequila crisis. Then you had the East Asian financial crisis in 97, the Russian crisis in 98, then Brazil and Turkey going to the IMF in 2001, 2002. It just seemed endless in terms of the troubles of emerging markets. And by 2002, I still remember speaking to a large pension fund about making an allocation to emerging markets. And his sort of response was that it's so small and marginal. Why do I want to invest in these rat-infested, mosquito-laden countries when here in the US, I'm getting such a great return? And then, of course, began the big boom in emerging markets after that. And by the end of the decade, in 2010, to me, the opposite was going on. That I was beginning to see the opposite scenes of what I had seen at the start of the decade. And what I mean by this really here is that there were 2 or 3 anecdotes which took place in late 2010, which showed to me about how many people had just bought into this theory that all these emerging markets were now set to rise and converge with the developed world. And that was coming after a decade of very powerful performance when every single emerging market boomed. And it was in sharp contrast to a decade ago when you had so many serial crises in emerging markets that nobody wanted to touch these countries or invest in them. So the key thing was then that what caused the boom of the last decade, and then why in 2010 did I begin to get concerned that there was something wrong when too many people are buying into this theory of mass convergence. So in late 2010, a couple of things happened which told me that, listen, we need to be a bit concerned here that not all these countries are going to be able to converge with the developed world. One anecdote was I'd gone back to India. They have an annual festival there called Diwali, which is the, in scale, equivalent to the Chinese Chinese New Year and the Christmas here. And I'd gone to this fancy party in one of Delhi's farmhouses. And they're called farmhouses because they're the outskirts of Delhi and they used to be occupied by farmers, but since and the farmers have got concessional land for farming, but since then the farmers have long left, but the rich and the decadent of Delhi have occupied those properties now and built up these very fancy bling farmhouses with lots of fancy features. Like this one I went to had of course a huge water fountain and also a railroad running through it to sort of take people around it, and it was a very fancy party going on with cars of Jaguars and other things being juggled by the valets, and inside the chefs had been flown in from various parts of the world for the multi-country cuisine to be offered there. And I got chatting there with this young 25-year-old, and he was the son of one of those recent entrepreneurs who had obviously made money very quickly. But this guy, he was a typical sort of Delhi kid wearing this tight black t-shirt with spiked gel hair and like attitude 25 and stuff. And he got chatting with me, he figured out who I was, that I was some Wall Street investor out here. And he sort of went to me and said, yeah, of course you'll be here in India. Where else will the money go? Right? So such was the arrogance that the West was in decline, all these emerging markets were rising. Where else was the money going to go? It was about, it had to come to places in India with its demographic profile and other sort of dynamism, etc. And that made me concerned because a decade ago, the attitude was exactly the opposite. It was all about America and about how the US and the tech bubble were doing really well out here. So that set me thinking. And then shortly after that, I went to Moscow. I was invited there to speak at a conference where then Prime Minister Putin was also going to be there. And so I was told to give a speech in his presence, and he was sitting exactly here as the professor is sitting, and I was here with the lectern, and giving us and I made a presentation where I was told to speak about what my frank thoughts on Russia are. I took that quite seriously, that I should be frank. So I started giving this talk about how my views on Russia had changed over the last decade. A decade ago, Russia needed political stability, it needed a strong leader, and Putin came and it like lower taxes, that was great, but a decade has passed, this model doesn't work for Russia anymore. It's like done nothing to diversify its economy outside of oil. There's not one company on the stock market which is a serious manufacturing company. So I give a pretty sort of frank chat about my thoughts on the Russian economy. I was not quite prepared that the whole event was being covered live by the media on state television, etc. Putin was sitting there taking notes down and stuff. I thought, fine, like it's going pretty well, even though I was a bit overawed by the situation. And like it ended, and next day I woke up and I was shocked to see the reaction in the Kremlin-controlled press. It was basically the fact that how I had come and spoiled the party, and the sort of editorial line was, "Who needs your money?" Right? That thank you for your advice, but no thank you. We don't really need your money. We're doing just fine. Price of oil is booming and set to go up further to $200 a barrel or whatever. We don't need this sort of gratuitous advice about what to do. So I was beginning to see this shift take place. Starting from these couple of episodes, I came back to the US. There was a conference there being held by by our firm, where we had invited the former President George Bush to be a speaker, and I was told to host a fireside chat with him. So I said, fine, I'd do that. Obviously, still smarting a bit from my Russian experience, I asked President Bush that you, a decade ago, had said that you looked Putin in his eye and you saw a friend. Today, what do you think about Putin? He said, let me tell you about Putin, that when I would meet him a decade ago, he'd be very concerned about Russia's debt situation, and their budgeting would be based on the fact that what if the price of oil goes back to $15 a barrel? The break-even price on the budget was $20 a barrel. This is by 2008, when I was leaving office and I'd meet him, he'd be asking me about like America's debt situation and what are you doing about the mortgage-backed securities and how the tables had turned. And he said that I could see the shift in Putin's attitude. That in 2001 he came to the White House. And my dog was playing around there, Barney and stuff. And obviously Putin had registered that. He says in 2008 or so, I'd gone to Moscow and I went to his dacha, and he asked me there that, do you want to meet my dog? So Bush said, fine, I'd be happy to meet your dog. And he said, out came this huge dog, basically. And Putin went to him, see, bigger, better, stronger, right, than Barney's. So you think that's how the whole attitude had shifted as far as Russia was concerned. So I was picking up all these trends and sort of internalizing and saying to myself that how the attitude has shifted, as far as emerging markets are concerned. And I said that I've got to write about this, because the fact that I've got to write an intellectually honest book, which basically makes the case that the last decade was a freaky decade for emerging markets. Never in the history of economic development had so many countries grown so rapidly, so quickly. We were underestimating as to why that had happened. A lot of that had happened because a lot of easy money was flowing out of the Western financial institutions, making its way into emerging markets, depressing the cost of capital, and the fact that we also were catching up for the fact that from 94 to 2002, it was a very poor period for emerging markets in general. So there was a catch-up going on, the cost of capital was really easy, and then of course there was the extraordinary rise of China, which after having boomed for 20 years had another extraordinary decade of 10% type GDP growth rate. In 2007, we forget now, China's real GDP growth rate peaked at 14%. So this was like an absolutely exceptional boom, and every single country was participating in this boom. The global tide of easy money was lifting all like emerging markets. Typically, like in any year, about 20% of emerging markets or countries in the world report a negative GDP growth rate. That's been the historical trend since in post-war history. In the peak year of 2007, of the 180 economies tracked by the IMF, only 3 reported a negative GDP growth rate. And these 3 were Fiji, Zimbabwe, Congo. Basically, who cares, right? So the whole world was booming. These 3 marginal economies reported negative GDP growth rates. The rising tide of global liquidity was lifting all these countries together. And then I was thinking how in 2010 the attitudes had had shifted, and yet the history of economic development was very different. There is no mass convergence. There are 180 economies in the world tracked by the IMF. Only 35 are developed. Everyone else is emerging, and many like Brazil, Mexico have been emerging forever. Which is like they basically have one good decade, stumble, then they sort of try and make up for that, and then they have another good decade, but their relative per capita income compared to the US hasn't converged much in the last 50, 100 years or so. It's been sort of stable. So it's a very difficult process to sustain economic growth and to sustain the good times. And yet the levels of overconfidence in some of these countries by late 2010 were to me quite remarkable. But if you look at the history, here's what the thing is. Every decade there's some hot investment idea or some theme which captures the imagination of everyone. What we find is that in the subsequent decade, that is no longer true. So 1980s was all about the rise of Japan. At the peak of Japan's boom, 50%, 50% of the global stock market capitalization was the Japanese stock market in 1989. Then the 1990s was all about technology, the TMT bubble which came into being. And it was remarkable to see as to how big the TMT bubble had become by the year 2000. 1/3 of all billionaires in the world came from the TMT space in the year 2000. Now flash back to like 2010. And what would be the really big theme of the past decade? The rise of the BRICS. That these large emerging markets had done very well, they were all set to rise. And the associated rise in commodity prices. And here's the telling statistic, by 2010, 1/3 of all the billionaires in the world came from the commodity sector. So like 1/3 of all billionaires from the tech sector in 2000, 1/3 of all billionaires in the world after the great commodity boom in 2010 came from the commodity sectors. And you could see the sociological shifts as, the favorite magazine which is read by a lot of the intellectual class is The Economist. And this perfectly captures how popular sort of cover stories tell you that when the trend is about to peak, or like in the year 2000, they had a cover story which had Africa as the dark continent, basically the hopeless continent. I think was the exact cover story. And then by last year, the cover story was Africa, the hopeful continent, after a big decade of boom in commodity prices. So my sort of basic take in this book is that trends do not last forever. The trends tend to last, for maybe 3 to 5 years, up to a decade often. There are a few exceptional trends that will last for a very, very long period of time, but that's not the norm. And as far as this decade is concerned, it's going to be very different from what we saw over the past decade. And we're now seeing the first signs of that already. This starts with China too. China's rise has been extraordinary over the last 30 years. Very few countries in the world have been able to sustain growth rates of even 5% on an average annual basis for 3 decades in a row. Very few countries have been able to do that. I think about only 10% of countries that were able to grow at 5% in any particular decade were able to do that for 3 decades in a row. So the odds are against sustaining economic success. China has been able to do that. But now we are reaching a very critical stage in China's stage of economic development, that it is roughly where Japan was in the early 1970s in terms of its level of economic development. For the first time, China's urbanization ratio now has crossed 50%. So a lot of the low-hanging fruit, easy sort of growth on a relative basis is past China. And now it's become a truly middle-income country. And from these levels, the rates of growth are bound to slow down. The question is, to what level? And in this regard, we did some work as to at what level it could slow down. It will follow the same example as Japan did in the 1970s, and the trend growth rate could slow down to about 5% or so, 5-6% or so in the coming few years. And on the other hand, if you look at some of the metrics, for example, that all countries, once their investment to GDP ratio peaked, or there was a turn in the credit cycle in that country, growth rates typically halved. So that also would argue that China's growth rate is moving down to about a 5 to 6% range. Now, of course, the question comes is, for how long will this last, and will it be 5 to 6 or something worse could happen? I think those are the open questions which I've tried to address in the book will be more sort of beneficial for everyone here to discuss those kind of questions. But let's make a couple of points here before we get into this discussion. That we have been great fans of China's economic development process, but there are a few fault lines which are emerging in the last few years that are giving us some cause for concern. One, that it's taking more and more of credit to generate $1 of GDP growth rate in China. So example, here's what I mean by that. Typically, when an economy is growing, so does the level of debt in the economy. Last 3 decades, the average was that it took just over $1 of credit to generate $1 of GDP growth in China, or $1 of debt. Last 5 years, it's taken more than $3 of debt to generate $1 of GDP growth in China. So now you're throwing more and more money into the economy to try and get the same bang for the buck. It tells you that the rates of return on investment are really declining. And then it also sort of tells you that you need to be concerned about the level of credit growth in China. Because if there's any single predictor of crises for countries in the world, it's only one, which is excessive credit growth. That whenever you get excessive credit growth in a country, that usually leads to trouble. And these excesses can be measured. Both the IMF and the BIS have done studies in terms of what is excessive credit growth. Very roughly, if your credit growth exceeds your GDP growth rate by a pretty sizable margin for 4 to 5 years, that's trouble. And that's what's happening in China in the last 3 to 4 years. This did not happen in China until about 2007 or so. But ever since then, in the post-crisis world, as China has been still trying to grow at 7 to 8% at least, that they're needing more and more of debt to try and generate $1 of GDP growth rate, and that is a worrisome sign as far as China is concerned. So that's something that we really think that what China needs to do just now is to sort of accept a much lower growth rate than it has in the past, because the very high growth rates now could be sowing the seeds of trouble down in the future because of the amount of credit it's taken to generate this amount of GDP growth rate. Because from this income level of about nearly $7,000 per capita income, it's very difficult to grow at a large pace. But and the other sort of rule that I'm very clear about is that when I talk about sort of projections, forecasts, my sort of horizon is about 3 to 5 years, maximum up to a decade. I think beyond that, it really is very hard to call because trends change too much, and also for another reason, as I sort of mentioned in the book, that the old rule of forecasting used to be that you make as many forecasts as possible and you remind people when you're right. The new rule of forecasting now is that you forecast so far out in the future that neither you nor I know whether we were right or wrong. Right? So when people talk about 2030, 2050, we'll all be dead by then or gone by then, and then we can have to live with those forecasts. So my point is, let's talk about the next 3 to 5 years. That's the practical view. That's what most sort of politicians, business people, investors care for. Because as I keep saying, I wish I could find a client to whom I could say, hey, give me your money and come and check your performance in 2030. It just doesn't work that way. Or a politician can't go back and say, come and check my performance after 20 to 30 years. So my best guess is that the next 3 to 5 years, we're likely to see a significant slowdown in China's GDP growth rate, possibly to a trend growth rate of 5 to 6%. I think that has some very significant implications for the global economic order. The most significant one means that this commodity super cycle of the past decade is coming to an end. That if you look at the 200-year history of commodity prices, it essentially is 1 decade up, 2 decades down. Because there's always innovation and other technological responses to high demand, which answer the problem of commodity demand. So we have this sort of cycle now where last decade we saw this huge increase in commodity prices as China's demand surprised the world and supply was quite constrained. Now I think it's turning on its head, which is China's demand is likely to disappoint as the GDP growth rate slows down, particularly led by investment on the downside, and also by the fact that supply is now really coming on the commodity marketplace. Over the past decade, the increase in capital expenditures in the commodity sectors has been 600%. For the other sectors, the number is closer to 200%. So huge supply response coming. So this really means that last decade, the big beneficiaries of China's boom, the major commodity exporting countries, now are going to run into pretty rough weather. Because the likes of Russia, the break-even price of oil is now $115 a barrel. The likes of Brazil, like you know that they're very dependent on their incremental growth rate on commodities. The parts of Africa which could suffer because of this, Australia, Canada, I think a lot of countries are going to sort of be hurt by the end of the commodity boom. On the other hand, a lot of commodity importing countries could be beneficiaries of this, such as even the United States, Western European countries, the likes of Turkey, the likes of possibly India. These countries could benefit from lower commodity prices. So the world, or I mean, to me, the global economic order is going to turn on its head of the past decade. But the big story, I think, which is what the market and everyone now is assimilating, is the fact that China's GDP growth rate is slowing down from the hyper growth level of 11% of the last 3 decades on an average annual basis to what I think will be the resting point average for the next 3 to 5 years of about 5 to 6%. And beyond that, who cares? So with that, I'd like to open this up for any discussion. Thank you.